welcome.
Welcome.
There's some food in the back. And I want to first thank everybody that's come out. Josh, when we planned this, I've joked with a few people and told them this, that we had a brilliant idea. We didn't consider the timing for you. And I really appreciate you taking the time. So we thought, yeah, it's tax season. This would be a great time to talk about taxes. Only it's a terrible time for you to take time out of your schedule because this is the busiest time of the year for you. And when I reached out to Josh initially, I said, Josh, we're going to do this talk. We'd already kind of had it planned and already invited some people. And I said, would you be willing to participate? He said, yeah, it sounds great. And he said, when were you thinking about doing it? I'm available in May. And I'm like, well, how about in February? So I appreciate you, Josh, participating and taking time away from your family and away from your business to talk about taxes. And I appreciate Becca for all the hard work she's done to put this on. And Blair, she's put a lot of work into this. Thank y'all for doing that. And thank y'all for taking the time out of your all's busy schedule to be here tonight to participate with us.
Yeah. So go ahead and get started. Well, you thanked everybody for coming. So that was my first talking point. I'm Rebecca. I'll be hopefully leading this conversation. I think everybody probably knows who this person is, but this is John Hendrix. He's a real estate agent and leader of Hendrix Group, which is the #1 team here at Keller Williams, New Orleans, and also owns a lot of investment properties himself. And then online is Josh McBride. He is CPA, and he works with several of our investor clients. So thank you so much, guys, for coming. And we also wanted to give Keller Williams, New Orleans a thank you for letting us use their space. And thank you for everybody here in the office and online. We really appreciate you guys taking time out of your day. Before we get started, just a little quick housekeeping. We want this to be as informative as possible. Josh can only hear you if there's a microphone. So if you have any questions, just raise your hands and we'll kind of go from there. So, and then people online, if you guys have any questions, just go ahead and drop them in the chat. And then we'll get to them probably a little later on. So, John, I think the last time we did a market update was probably about 9 months ago or so. Do you want to kind of get us started and kind of tell us what the market looks like right now?
Yeah, absolutely. So
I think you got some slides too.
Yeah, so at that market update you're referring to, there was a lot of negative headlines about where the real estate market was going. Some of those have been true. A lot of it has been overblown, but in the fall, we experienced much higher interest rates. Everyone here, I think, is aware of that. And that did slow the real estate market down the last quarter of last year. However, one of the talking points at that little talk that we had in the fall was that a lot of the fundamentals of residential real estate across the country on kind of a macro level within the United States were very strong, were very positive. So we're going to look at a few of those charts that show that. So this is the national median price. Is that what we have?
Blair, do you have the clicker?
Yeah.
Can we...
First slide?
Yeah. Do you want to drive?
Sure.
We should forward and back.
So this is the national median sale price, and I believe this is for single family home is what we have here.
Mm-hmm.
So for some reason it's showing a little different on there as far as the year, but 367 is the national median sale price. Let's see here. This is one of the most encouraging charts, I think, when you're looking at real estate, when you're talking about residential real estate. And if you read a headline that residential real estate is going to crash, right? So in 2008, you see this big drop off, right? This is housing starts. And you can see leading up to 2008, it was a very steep incline, right? What's more important in this graph than how steep that is and how big of a drop you see in the years after 2008 is the actual number of homes that have been built since, right? So we, in 2000, maybe 18 was the first year that we were above 1 million. And there was like 1.8 at the height. And we have not gotten anywhere near that, right? So one of the things we talked about in the fall was that not only are the housing starts way down compared to what led up to even going back to 1990. You know, we're not building nearly as many homes as we were building even, 35 years ago. The housing starts have been way, way down, and the demand is not correlated with that. So there's actually a lot more demand today. Real simply, I'm not going to spend a lot of time on this, but real simply put, with demand, there are a lot more buyers, just traditional buyers, that are engaging in the market right now than there were in 2008. So millennial age is a big demographic of buyers that are kind of in their prime buying time. So there's a lot of people sitting on the sidelines that most economists are predicting are going to be participating in the real estate market. So that's encouraging for real estate values. But in addition to that, before 2008, there wasn't a lot of Wall Street money in residential real estate. That's a relatively new thing as far as them actually buying homes. And there were markets in 2020, 2021, where there was a big chunk of the residential real estate was being sold to big time, hedge funds that were coming in from Wall Street and were buying real estate. And that was not something that mom and pop buyers were competing with 20 years ago. You were just competing against your neighbor and your friend. That's not the case. There's a lot of money buying residential real estate in certain markets. New Orleans isn't really one of those that you're seeing a lot of that, although there is a presence here. I've met with someone with BlackRock, I think it is, that they were trying to get established here, but Dallas, Phoenix are a couple of markets where I heard at one time during kind of the height of the real estate market that somewhere like around 20% of residential homes were being bought by institutional investors.
Wow, that's a lot.
A ton.
Yeah.
So in the Dallas like metro area. So you have a lot more appetite for residential real estate than you had in a couple decades back, and certainly back in 2008. And the inventory has not spiked, right? So that you can see that we're not really building that many homes, and appetite to buy them is healthy. Interest rates. So interest rates is something you should keep an eye on. And if you look at interest rates and go several months without knowing what's going on, you probably don't know what's going on. I talk to buyers all the time that say, "Oh yeah, rates are 4%, right?" And I'm like, "No, they're not 4%."
Well, I thought they were 7. So.
Well, and they were 7, they were 4, they were 3. So we're, you can get a 30-year mortgage right now for around 6%, depending on the type of mortgage you're wanting to get. FHA, you could be a little bit lower than that. Now, we've got primarily investors here tonight. If you're looking to get a commercial loan right now, it's pretty steep. It's much higher than what you see up here. If you're getting a commercial loan to buy an investment property or to do a construction loan, I'm seeing those rates 7-8%. So they're not low right now. So this is local, and this shows a chart of the median sell price in New Orleans, and this is for single family homes. There was a very slight downtick from December to January. Last year there was a big drop off. I believe it was from June to July, if I'm not mistaken.
Yeah, we heard that like the sky was falling, like right around hurricane season.
Well, it did. It did, but it didn't continue to fall. It has kind of plateaued. The median sell price went from, in the metro area, which actually isn't represented up here, was just shy of $300,000 for a median sell price in July, I believe it was, and then in August it was like $260. So it was like a 10% drop in 1 month. Not in a year, in a month. I mean, 10% a year would be a big drop, but 10% in a month is crazy. And that was very, very concerning. I'm sorry. It was very, very concerning. How did I get back to? There we go.
But like overall, I mean, we're talking year over year. We're only talking a $5,000 difference between January 2022 to January 2023. So it looks like a lot of that sky was falling was really just a huge gain that the market was due, like maybe even seasonality, or what do you think?
Yeah, some of it. I mean, the rates were very, very low. As a big part of it, that was fueling, I think, a big portion of it. One thing that when I look at this is that it's pretty clear, this is not as far back as I'd love to see, but it goes up, right? Even when it has a steep decline, if you look a couple of years into the future, it's much higher than that. Let's see here. So this is showing you that, you might see negative headlines about real estate. Homes are selling for pretty close to list price. Now, this is a little bit misleading in that it doesn't take into account price reductions. So if you have, David's one of our top listing agents in our office. If he has a $50,000 price reduction on a property and then sells it for that price, it's accounting for it being close to the list price, not necessarily where you started. So it's a little bit misleading, but that applies for the previous years too. That's still true. So homes are selling for pretty close to where they're listed.
Yeah, it kind of seems like, we can see the slides right here. It kind of seems like buyers just aren't negotiating. Like, so it really depends on where you list and where you market to.
That's important. I've had 3 deals this year where I was representing an investor client or a home buyer client who made cash offers, some at full asking price, some very competitive. I've had 3 in 30 days, we're only 32, 33 days into the year, they missed out on the property.
Really?
So there's been 3 cash offers darn close to the asking price that didn't pan out. So there are still competitive situations out there. There are still, if the property's priced right and there's something unique about the location or unique about the property, there is still a healthy demand. And those were cash offers. These were not people putting very little amount down. These were very few contingencies, if any, very strong offers. They're offers that get accepted in most markets. So there is still a healthy demand. So days on market, as a seller, we've been really, really spoiled. It's gotten to where if the property hasn't sold in the first 2 weeks, the owner is calling like, what's going on? What's wrong? What are we doing wrong? You must be doing something wrong. Historically, 4 to 6 months is kind of the range of where, and it depends on who you ask, but between 4 and 6 months is kind of where it swings from a buyer's market to from a seller's market to a buyer's market. If it's more than 4 months, 5 months, then that's more of a buyer's market. When it's less than that, it's more of a seller's market. This is this was New Orleans Metro. Yeah. So 50 days, I believe this was median days on market. So properties are selling within a couple of months of being listed and they're selling for pretty close to their asking price. Homes for sale. So one thing to point out in this that's not represented is that everything that we're hearing within our office is that this number is about to jump. So we're hearing from a lot of people that there's going to be quite a few listings that come right around Mardi Gras, post Mardi Gras, which is normal. That happens normally. But if you're looking to buy, there are going to be some really good opportunities on the horizon. So within our office, we have an opportunity to promote people's listings without necessarily promoting them to the world. We have a contract that we can sign where the office can basically promote within itself certain listings, and we've got, I think, probably more than we've ever had that are going to go live on the MLS, right at Mardi Gras or post Mardi Gras.
Well, let me we were talking about, so interest rates seem to be kind of leveling off a little bit. I know that there is a special session going on right now or earlier this week where the governor was trying to get the foothold with the whole homeowners insurance situation kind of leveled out. It looks like there's going to be way more inventory. It seems like it's going to be a pretty decent time for a first-time home buyer to kind of get into the market. So let's kind of talk about that. And I want to get Josh in on here too. So John, just talk a little bit about the differences in renting versus buying. So if somebody who is maybe spending, we see rents that just keep on increasing year over year. What are kind of the benefits from just not even taxes, but just a monthly budgeting situation that, homeowner can benefit from as opposed to being a renter, making that jump?
Yeah, I mean, for one, it's just a lot more stable, right? You're not having to ask questions about whether you can paint a room. There's a lot of positive things that happen with owning a home that are not related to finances. But when we're talking about finances, you're fixing. Now, we've had some conversations tonight about insurance, but we're fixing the biggest cost of living in that home, which is your payment to the mortgage company if you're doing a mortgage. So you're fixing that for 15 years or 20 years, or most people 30 years, and you're fixing that price in place, right? Whereas the cost of renting is going to go up over time. You may have some fluctuations where it goes down, but over time, rents go up.
Right.
And the payment doesn't go up unless the insurance affects it. But the payment to the mortgage company, is flat.
Yeah. So monthly payment, you'll know what's going to kind of basically come out of your checking account every week, every month. Josh, I'm sure that there's millions of tax benefits to own your own home instead of renting. Ready to hop on in?
Yeah. When you're renting a home, there basically is no tax advantages. You can't deduct anything. Everything's kind of personal, non-deductible expenses. If you own the home, there are a few things. Everybody's probably heard of standard versus itemized deductions. And that's probably the biggest thing is you can deduct property taxes, mortgage interest, and there's a certain level you have to get to for that to be beneficial. There's also energy efficient tax credits that are kind of making a comeback in 2023. The amounts of those tax credits are increasing, so that's kind of a big thing right now. And that's if you're buying windows, doors, HVAC systems, things like that. So that's stuff that a homeowner can take advantage of that you can if you're renting.
Tom, I think you're looking into doing that, right? We talked about that before.
Yeah, we're talking about, all that stuff that you're talking about, like we're looking at doing a heat pump system and putting in the whole house. Oh, sorry. We're looking at doing heat pumps and getting I guess it's a 30% tax credit for that.
Oh, yeah.
So yeah, we're excited about that.
Yeah, I've had a couple people get huge tax credits on those. That's a good deal.
And then, John, there's also like other benefits. New Orleans is very unique in the fact that there's a lot of housing stock that is multifamily. We're not a city of single family houses. Can you talk a little bit of some of the benefits of maybe somebody who's looking at either buying their first home as a single family house or multifamily? Or maybe, is it time to buy that investment property, that second or third, or, make that jump?
Yeah, I think a majority of the people in this room, oddly enough, either as their first piece of real estate or in their current living situation are doing that very thing, myself included, and you, and I think Tom and Daniel to a certain extent are in that boat. I think it's a phenomenal way to buy your first property. There's a lot of neighborhoods. New Orleans is unique in that there are a ton of neighborhoods where there is a real mix of single family and multifamily properties. It's not like that part of town's multifamily and this part of town's single family. We don't have a lot of subdivisions, a lot of parts of the city. It's not set up like that. So huge advantage to be able to offset your cost of living renting out part of your property, depending on what's going on with Airbnb. We're not going to get into Airbnb, short-term rentals tonight, but there are a lot of people that take advantage of that by utilizing part of their asset to short-term rent. But yeah, I think it's a great way to own your first home. Financially, it just makes a lot of sense.
Yeah. So not only do you get rent, but there are some expenses that come out for it. Like Josh, if somebody's looking to put together and buy their first property, either as a multifamily or as, maybe their second property, that's an investment property, what are some of the things that they need to be aware of that they can track for tax purposes and write-offs and stuff?
Yeah, sure. I mean, for the most part, it's cash in, cash out, right? Rental income's taxable when you receive the money. Things like repairs, property taxes, that kind of stuff is deductible when you spend the money. The biggest deduction is probably what's called depreciation expense. And basically that's the IRS's way of allowing you to write off the property over time. And they've got, I don't know why, but the number of years is 27.5 years that you depreciate a rental property. So just kind of doing some simple math, if you buy a $300,000 rental property, and let's say the land's worth 25 and the building or the house is worth 275, you would get a $10,000, 275 divided by 27.5. That's a $10,000 depreciation deduction a year. So that's how you eventually write off the cost of that property. So,
Well, I think that's a really big factor in evaluating a deal that a lot of investors, particularly, someone's kind of new to investing, doesn't take into account. A lot of times they're looking at strictly cash flow, which is important.
Yeah.
It's definitely a part of evaluating the deal, but the depreciation is a big factor. And sometimes, depending on someone's tax situation, that depreciation is what makes a deal a great deal and what makes a deal one worth passing on.
Yeah, absolutely. So what can get depreciated?
yeah. So, like I said, in my example, $300,000 property, whatever the land is worth, you can't depreciate land. It doesn't go down in value. So the IRS doesn't let you take a deduction there, but whatever. And I normally go to the tax assessor's website and just say, well, what are they valuing the lot at? And everything on top of that is the house. And without getting too far down into it, you can actually kind of segregate it out. Okay, this is maybe 5 or 10% of the house is furnishings that you can write off over either 5 or 7 years. But the big bulk of it is going to be that 27.5-year life property. So, if you redo the landscaping, any kind of major improvements you do on the house on top of that initial purchase price is what you appreciate as well.
And can you do this for single family houses, or is it only something that you do with multis, or investment properties versus your home yourself? Like, who can take advantage of this strategy?
Yeah. So no personal residences. You can't write off the cost of your personal residence, unfortunately. This has to be a rental property where you're for profit, and it doesn't matter if it's an apartment complex or a single family rental. The IRS kind of looks at things. You've got residential rental and you've got non-residential rental, which would be like if you had a retail tenant. So those are kind of the two categories from a tax perspective. Is it a residential property or is it retail?
Josh, if someone like Rebecca or someone like Tom, they live in a property that's dual, they can depreciate what, like a percentage of the square footage that they're not occupying?
Yeah, so I live in a triplex. So I have, one unit me and my family live in, and then the other 2 are rentals. So kind of, do I do out 2/3, or kind of how does that work?
The common method is just based on square footage. So if 1/3 of your property is rental, 2/3 is personal, then things like utilities and all that kind of stuff, the insurance on the property, just prorate it.
Cool. That sounds like a great thing. So after 27.5 years, so you're finished your depreciation schedule, you can't get that tax break anymore. What now? Like, do you sell it? Do you keep it? I guess that's a personal question, but let's just kind of talk about, if it's time to sell, what are some strategies people can do to deal with that sale and that tax burden that sale will probably.
Yeah, and let me back up just a little bit, because one of the good things about real estate is if you invest your money in AT&T stock and it's paying a 5% dividend a year or whatever, that 5% dividend is taxable every year. Okay, your return on investment on real estate, it's kind of a non-tax. Normally with the depreciation expense, it's kind of a tax neutral event as long as is until you run out of depreciation expense. So, you may go 15, 20, 27 and a half years and pay very little tax. And at that point, you got a lot of equity in the property, but that's not taxable until you sell it.
Right.
So, that's option one. If you want out of the property, you can sell it and pay the long-term capital gains tax. And, some people choose that route. Another option is they have what's called a 1031 or a like-kind exchange. And that's what we see a lot of as well. You basically, you got a gain, but you just defer that gain and you have to roll 100% of the proceeds into another property. So in theory, you don't really come out with any money. You're just kind of rolling that equity into the next property. But I've seen people do that for years and years and years and defer the tax, potentially forever. So.
Well, that sounds like a great strategy. Is it easy to do?
I always thought it was crazy that you can depreciate an asset and get a write-off on an asset that's going up in
Right.
value, if generally speaking. So yes,
Yes,
I think it's
absolutely.
incredible.
I mean, that sounds like a great strategy. John, I know you've done a few 1031 exchanges. What do people need to know? I mean, is it pretty easy to pull off?
No.
Okay.
Well, we're not getting into the nitty-gritty details of it. There's a lot of information about it. And we're happy to share that if somebody wanted to talk about what that looks like. We can kind of talk about the ABCs.
At a high level.
Yeah, so there's a lot of planning is involved to do
Okay.
it well. One of the things Josh and I talked about, and we're very much on the same page, was that the way to not do it is to force it to happen. And you make a bad investment because you're trying to avoid paying taxes. So it can be great. There's a lot of planning that is involved with it. So just on a very elementary level, you have to have a third party involved that basically holds the money from the sale. There's some paperwork you got to make sure. So there's companies that specialize in doing this. First American is the one that I've used in the past. They did a great job and their fees were low. I want to say we paid south of $1,500 for the whole thing. The fees I've seen on most of them are $1,000 to $2,000. I have seen some law offices that are way more than that, but it's not necessary. Yeah, so you have a specified period of time from the closing to identify the property you're going to buy, 45 days, and then you've got 180 days to close on that property. The property or properties, the accumulation of the properties have to be more valuable than what you sold. Josh, is it more valuable than what you sold or more valuable than the gain?
The proceeds. So yeah, the total proceeds that you sold it for. So yeah, that's commonly confused. People think, well, I made $100,000 in the sale, I only need to reinvest 100. No, you have to reinvest 100% of the proceeds. So
what I have seen some savvy investors do is, they say, hey, I want to do a 1031 exchange. I don't want to pay the taxes on it right now. I want to kick the can down the road. I want to defer those taxes. But I need the money.
Yeah.
But I need the money for something. So through a structure of where you're doing the 1031 exchange properly, where the money is flowing correctly and you never touch the money. That's one of the things about 1031 exchange is there's no grace. There's strict rules. If you break one of them, it's done.
And it's almost like those rules are set up to catch you, like they're just pitfalls and traps everywhere. So you gotta be really.
Yeah, they're tough, right? There's strict rules. It's clear cut. You follow these, 12 rules and it'll be successful. And if you don't, it won't be. But what I've seen some savvy investors do is they will do the 1031 exchange. They acquire the property, and then through basically a back door through financing, they're able to pull money out. Right. So if you're selling a $200,000 house, and you're buying a $300,000 house, well, the bank may only need you to have $60,000 or $70,000 of your own money actually invested in that for them to loan you the money. And you could pull out, in theory, $200,000, $240,000, whatever it might be, through refinance. And that is actually not taxed.
Okay.
So you're deferred. And Josh, tell me if I say anything that's not legal.
No, you're right.
Yeah,
you're
we
right.
can. Well, let's just kind of back up and not just necessarily talk about it from the 1031 exchange perspective, because that is a very complicated way. It sounds great, but it sounds very, very complicated. Could somebody grow their portfolio by just doing a cash out refinance on their personal home or something along those lines?
Yeah, I mean, it's definitely a strategy that some people use,
Okay.
some more aggressive than others.
Yeah.
Yeah, it can be a great way because if you think about it, the equity you've got in a property isn't doing you any good
Mhm.
until you sell or pull that equity out somehow. So there are investors that will put that equity to work before they sell the house through a refinance, or if it's your personal home through a home equity line of credit. It's kind of a sort of the same thing. They're totally different, but
Mhm.
gets you to the same result of getting cash in hand, and that's not a taxable event, which is great, right? So if I've got a home equity line of credit of say $100,000,
Right.
I'm able to pull $100,000 out
Mhm.
that's not taxed.
Mhm.
So one thing we didn't even touch on, we've got a lot of savvy investors in the room. This is a very elementary thing, but the sale of your personal home is not taxed for a certain amount of money. So for an individual, it's $250,000 of gain is not taxed. And for a couple, $500,000 isn't taxed. Anything above that is taxed. So there's builders that their whole strategy is to build a home
Mhm.
and always be building their next home,
Mhm.
pretty much.
Mhm.
And they're in that home for 2 years and then they're into the next house. So they're always living in a new home.
Right.
And every one of those sales, if they're making money, all that's tax free. Well, as you've lived in the home for 2 out of 5 years.
Yeah.
So that's a phenomenal. The IRS and the federal government, they want you to invest in real estate. Is that true, Josh? Like, I mean, there's a lot of tax
Absolutely.
advantages for investing in real estate. They're basically begging us to invest in this asset.
Yeah, you broke up a little bit there, but yeah, absolutely. I mean, the rules are set up to make, real estate it's a tax efficient way to grow wealth. And so, yeah.
Mhm. I kind of want to go back to, I know that a lot of people refinanced when mortgage rates were at 2-3%. And I know a lot of people when early COVID, when there was a lot of uncertainty in the job market, unemployment was very high. People decided to kind of take an opportunity they were looking at either, do I take a draw from my 401k or do I do a refinance, take some cash out? Or do I kind of do like a personal loan situation? So Josh, you said, I know a lot of people took that cash out refinance situation. Josh, did they have to pay taxes on that? Is that considered income?
Normally, no. If you've got a property in a corporation or something like that, you could have some issues. But typically, if it's structured properly, you should not have any tax consequences from a cash out refi type situation.
That's great to hear. And then, John, you mentioned a little bit about a HELOC, a home equity line of credit.
Yeah, if you've got equity in your home, it's really a great thing to consider, at least something to know about. It is one, it's not taxed, the equity you're using. I don't think it's a great thing if you're wanting to upgrade your vehicle. I'm not a big believer in using it for just upgrading lifestyle, but if you're looking at it as a way to buy an asset, like a piece of real estate, I think it's worth considering looking at. Most home equity line of credits, they're not looking over your shoulder. If you've got one, they're saying they've got equity in the property. They trust you to use the money. They don't really care how you use the money because they've got equity in your property. If you mess it up, they're going to get your property.
Yeah, it's dead. Yeah.
So I have seen multiple investors that will use that as a way to propel their real estate investing. I think if it's done responsibly with guidance and some due diligence, I think it's a great thing to do. So one of the things I like most about the home equity line of credit opposed to a refinance, if you do a refinance, you pull $100,000 out, doesn't matter the interest rate. You're paying money, you're paying interest on the money right away. Whether you've found a place to park it or not, if it's just sitting in an account, you're paying interest on that money every month. With a home equity line of credit, it's more efficient. The rates may be higher, but you're not paying any interest on the money. until you need it, until you're using it. It's there, it's available, but you're not paying anything on it. And then you can, use it as needed, and there's less pressure. I see people refinance with investment properties on intents to reinvest it, and they know what they're doing. They're savvy, but they also, there's a pressure to make a deal happen. They've got the money, they're paying interest on the money, and there's a unnecessary pressure, and you don't always make the best decisions in
Yeah,
that situation.
that's a great, yeah. I mean, Josh, should somebody spend money for the tax benefit? I know a lot of people who say, let's put it on the credit card because I'll get a tax.
Yeah, it's a write-off. It's a write-off.
Yeah, it's a write-off, right?
No, the math, it never works that way. The very most you're going to save is, the top federal tax rate's 37%. Louisiana, it's a little over 4% now. So you're talking about 41%. You go out and blow $1, you're going to save 41 cents in taxes. It's never dollar for dollar. You can't go out and spend $1 with very limited circumstances. There are some things where you could donate $1 to charity and get a state tax credit for roughly $1. But for the most part, you can't go spend $1 and save $1 in taxes. So that the saying that we have is, don't let the tax tail wag the dog, which means, you don't make decisions solely for tax purposes very often, because it's an important part, but it's not, a bad investment's still a bad investment. It doesn't matter if you save a few dollars in taxes or not. It's better to have that good investment than spend $1 to save 40 cents.
Right. You mentioned something about tax credits. I know we talked a little bit about energy efficient credits earlier. The state and the federal government do have really great programs for historical tax credits. So just wanted to say that if there is a historical home that you absolutely love and you want to renovate, you could potentially recoup some of the money that you were already planning on spending.
Yeah, if you're looking for a property, if you're looking, to renovate a property, it's something you definitely should look at. The state of Louisiana has a 20% right now state tax credit on your renovation costs. And there is actually a vehicle, which is a taxable event. But there is a vehicle in which you can turn that tax credit into cash.
Mm-hmm.
Like you can actually sell the credit, for lack of a better term. And there's a 20% federal tax credit on the renovation cost. So Tom, who's in our audience, he's taking advantage of that on some properties, and it's if you like Josh said, you don't want the taxes, the tax tail to wag the dog. You definitely don't want to with that either. You can make a bad investment even if all the tax credits are eligible and would work. But if you're getting a property and it's a decent value without the tax credits, and you can utilize the tax credits in that property, it's a home run. There's really nothing else that I know that's I don't want to diminish how complex it is, but it's rather simple compared to a lot of the other tax advantages of like a lot of developer language for bigger time projects. They're complicated. There's a lot of people involved. The historical tax credits apply to those larger jobs, but they also work in Louisiana for a double. You can buy a duplex and take advantage of the historical tax credits. And the people that are administering those with the state and the people that are administering those with the National Park Service are used to mom and pop investors. And I would say they're fairly easy to work with for the most part. And the process is not all that difficult. And there's people in town that consult and do that type of work as their job or as a side gig. There's people that know a lot about the process and can guide you through that if that's something you were interested in. I've participated as a contractor on some of those and as an investor on some of those, and I think they're fantastic.
Awesome. Great. Well, I've asked a lot of questions. I know that was kind of the role of me being here, but I do want to open it up to everybody else. So Blair has a microphone. That way Josh can hear you if you're if you're here and you have any questions. And we can also see if there's any questions that are online too.
We do have an online question.
for Josh or John, I guess. I have a duplex with only one water meter. Should I get a second meter installed so that I can write off my tenant's water usage?
What city is it in?
Orleans.
So Josh can speak to the tax write-off. I can tell you from adding a water meter in the city of New Orleans, I can't really speak for Jefferson Parish. I haven't done that. But adding a water meter for a property is probably a $5,000 to $7,000 cost. So there's just a math equation there from that perspective of if it's worth it. I have done that on investments. I've spent that money on the front end of an investment because I saw the value of not paying the water bill for a duplex and let each tenant be responsible for their own water. There is an expense. It's not just you call the sewage and water board and they come out. But Josh, from a tax perspective,
Yeah, I've never had that come up in an exam or anything, but I would imagine that the IRS would be pretty reasonable if you were allocating it based on square footage or some reasonable method like that. I don't think that they would totally disallow 100% of your water costs when you've got a tenant obviously living there. You've got rent income on your tax return, all those things. So.
Hey, this is Daniel. You touched on depreciation a little earlier. I'm starting to learn about the idea of bonus depreciating a rental property. So if you were to take 100% of that bonus depreciation, actually, is that even possible anymore? I've heard you can only do like, I think 60% this year, maybe 40% next year, something along those lines. Are you familiar with that?
Yeah. So we are in a period, I think 2022 is the last year of 100% bonus, and it starts getting phased out. You got it. I think it's 80% in 2023, and then it goes down 60-40. And what bonus depreciation means is you can just write off 100% of the asset. Now it's got to be, we talked about rental houses are 27.5-year life. It's got to be 20 years or less to qualify for bonus depreciation.
Okay.
So if you build a fence on the property, if you buy, new appliances, things like that, you can absolutely write off 100 or 80%, whatever it is that particular year. I think where, I talked about residential rentals versus non-residential rentals. So let's say you had a rental property that's got a retail store in it. You could basically gut and redo that whole thing and make major improvements. And that's what's called a qualified improvement property. And you could take bonus depreciation on that. So we're seeing a lot of that. A lot of that happened the last couple of years. I think that was a 2018 Tax Cuts and Job Act change. Now that doesn't apply to residential rentals. That's on the non-residential rental side. So you got to be careful when you're reading these articles and things, because they may not specify very clearly.
and Josh, to be clear, because commercial and residential, they mean different things depending on who you're talking to. A banker says one thing, but for the IRS, you mean that nobody lives there.
That's right.
It'd be an apartment complex. It would have to be a strip mall or a store
Correct.
unit.
Yeah, exactly. Or, an office building where somebody's going and working, but yeah, it can't be where somebody lives. That's right.
And are there any downsides to it other than having a smaller return in following years? Are there any real downsides to look out for with bonus depreciating?
It's a timing difference. That's really what it is. You're accelerating your deduction because, you're going to get it. If it's a 7-year property, you're going to get to write that off over 7 years. All bonus is doing is allowing you to accelerate that to year 1. So, yeah, if you then sell the property 7 years later, you're going to recapture that gain. You're going to have gain on the sale. So, but time value of money type thing. Deduction today is definitely worth more than a deduction next year, just from a time value of money standpoint.
Right. Okay. Thank you.
I didn't know that. I didn't know about that until we did the prep. I think, Dan, you had some information about it. I think, Jason, you knew a little bit about it, but you know, I'm primarily involved with residential real estate, and I didn't know that's, I think that's crazy that you can do that you could buy a commercial property and write off 100% of the improvements, you know, year one.
Josh, we do
Yes.
have one more online question. I'm sorry. Go ahead.
I was just gonna say that was, you know, one of those things that, the way that government encouraged investment in real estate was, hey, you can write it off all in year one if you want to reinvest money into your property. So.
Blair, it looks like you just got an online question.
I did.
Can you see that from your phone?
Let me squeeze back. I have this one too. I work from home. Let me go turn that on. I work from home. Can I write off my mortgage or a portion of my mortgage?
So the IRS has, and I'm assuming you work from home, meaning you're an employee, you're not self-employed. I think in 2018, that same year when the Tax Cuts and Job Act was passed, they did away with any sort of employee unreimbursed expense. So if you're a W-2 employee, there's really nothing you can deduct. There's no home office, nothing related to your job, no mileage, all that got axed. Now, if you're self-employed, that's a different story. You got two methods. You can either allocate or prorate. Let's say your office is 100 square feet and your total house is 1,000 square feet. You know, you can write off 10% of your expenses based on square footage, or the IRS has a simple method that's it's just $5 a square foot. So, you know, 100 square foot office, you can get a $500 reduction.
And we had, Josh, we had one more online question. I was trying to get it to where you could see them. Let me read it to you real quick. Are there any different tax considerations in HELOC on primary residence versus investment residence?
Good question.
As far as deducting the interest expense, you know, a home, if it's your primary residence, it's mortgage interest essentially. So whether or not you itemize is, you know, if you're not itemizing your deductions, it's not really helping you. If this is interest from a rental property and you're using those funds to reinvest in the rental property, then you could deduct that interest expense against the rental income, which would be more beneficial.
And then Josh, a second question from Jessica as well. Are there any conflicts between applying HELOC interest deductions and depreciation deductions on an investment property?
No, two separate deductions.
If I used my HELOC, use it for an investment property, I'd be able to write off that interest.
Correct. Yep. Yep. Just like the initial, you know, acquisition interest, you know, when you acquire the property, it's deductible. You refinance it, you borrow against the property, that interest expense is deductible as well against the rental income.
Yeah.
Hey, so I have a regular W-2 income, but I do a lot of real estate work on the side. And if I were to spend more time doing real estate on the side than at my regular W-2 job, which is very likely, do you become do you achieve that real estate professional status that helps you out with taxes? I know from an audit perspective, I've heard even if you do and you can document it, it's irrelevant because if you have a W-2 income, you are not a real estate professional.
Yeah, and the problem is there's been court cases where, you know, doctors or people that obviously have very demanding full-time jobs have claimed to be real estate professionals.
Right.
And the IRS is pretty aggressive when they go after those. You have to, I'm not gonna get into the rules, but yeah, you have to spend more than half your time in real estate. There's an hour requirement. If you meet those real estate professional, if you are able to jump through all those hoops, what it allows you to do is deduct losses on rental properties potentially, because your normal, if you have a loss from a rental property, it may be limited. You may not be able to deduct that year. You may have to carry it forward. So, what people are after is to be able to deduct that rental loss against other income, right? Against your W-2 income. So, yeah, it's possible if you meet the test. There's some pretty bright line tests there. I would encourage you to keep good records, keep logs of your hours and things like that nobody wants to do, but that's what the IRS wants to see. So.
Okay, thank you.
Josh, with the, we touched a little bit on historical tax credits and Daniel's question about real estate professional, like if you took advantage of the historical tax credits, aren't there some advantages to being a real estate professional in regards to that? I remember something we talked about with our credits, that the way you could apply those credits to your, basically to your return, you had a little more liberty.
Yeah, that's the passive versus non-passive activities thing. If you're a real estate professional, your rental activities are not automatically passive. They may be non-passive, and that's just, you get a little more flexibility. You're absolutely right.
Right.
I'm wondering if there are circumstances under which short-term rental income can be taxed the same way as regular rental income.
Great question.
Yeah, so that's a good point. There are a different set of rules. I think it's if the property is on average leased for 7 days or less at a time. I think it's the rule. You have to differentiate between that versus just a long-term regular rental property. Don't ask me all the differences, but yeah, you kind of do have a different set of rules there. Doesn't change the fact that you can, depreciate the property and write off expenses and all that, though. I mean, that stays pretty consistent.
So 7 days is the criteria. So if for instance, if Tom's got a short-term rental and maybe he's got some lucrative stays around Mardi Gras that are 10 days, that would be like on one side, like in one column, the 10-day stays, and then the 5-day stays would be in a different column.
Yeah, technically you should go through and break those out, what's the short-term versus the long-term rentals.
One of the reasons I was asking is I'd heard, I mean, this is secondhand, that there might be, depending upon how much work you, as the person who's earning that income, how much work you actually put into that short-term rental. That if, for example, I mean, you're not the person doing the cleaning, there are certain duties that you're just not doing, that if there's enough of that you're not going to be that would be treated as as regular rental income, not and I can't think of the tax form that you get from Airbnb or whatever, but that would be basically treated as like regular rental income. That your level of effort. I'm not sure if that's the way of putting it, but just kind of my understanding.
Okay, are you talking about income taxes or is there
Income taxes.
Okay, I know some states, cities have like a hotel tax type deal on short-term rentals. Yeah, I mean that's probably, you've got passive activity rules. If you spend a certain amount of time in an activity, it's not passive. Rental real estate is just generally, it's by default a passive activity, right? It really doesn't matter how many hours you spend unless you meet the real estate professional rules.
I mean, if, as a CPA, what would you feel comfortable with if you had a client who was doing a short-term rental and they're saying, you know, I'm not really doing much. Like, what would you want to know to be satisfied that they weren't doing much indeed?
You know, I'm not in the business of auditing people. So, you know, I would just tell them, what I typically do is just tell them the rules and, you know, let the taxpayer make the decision. So.
Okay.
Great.
Thank you.
All right. Well, thank you so much, guys. I appreciate it. Josh, thank you so much.
Josh.
We really appreciate your time and your energy and sharing your knowledge. If you guys would, if either anybody in here or online would like to connect with Josh, talk to your favorite member of the Hendrix Group and we can get you their email address and connect you guys. So, you know, he's a great CPA. He's John's CPA and he's highly recommended.
Several clients,
Yep.
yeah.
Great. Well, thanks, guys. There's still some margaritas and tacos for everybody in the room. And this has been recorded. So if anybody wants to have it, we'll get it out to you guys. And so this is the end of the formal conversation and we can keep chatting. Thanks, everybody.
Thank you.
Thanks for having me,
Appreciate it.
guys.